We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
In late 2017, I was tasked with building an environmental, social, and governance, or an ESG portfolio for PlanCorp. And to be honest, I was initially less than thrilled because my past experiences with these types of portfolios were not necessarily positive. ESG strategies previously showed up to me as ones driven by emotion, where people tried to align their investment portfolios to their personal values, and as a result, it generally hurt their performance along the way. But then I started to do my research to build out PlanCorp's ESG portfolios, and I quickly discovered a lot has changed in the ESG space from when I formed these initial impressions. First of all, ESG investing no longer refers just to values-based investing. There's a lot more out there available for investors, but more importantly, there's an increasing amount of compelling research showing that companies doing a good job of addressing ESG issues in their businesses tend to outperform companies that are doing a poor job on ESG issues. And that's good news for the growing number of ESG investors who want to build portfolios aligned with their environmental, social, and governance goals. But if you want to incorporate ESG investments into your own portfolio, it also means you're required to navigate a pretty wide range of approaches and options to find the best fit for your personal beliefs and financial goals. Now, I know that ESG investing can mean a lot of different things to a lot of different people, so I'm going to break them down into 6 distinct categories for incorporating ESG criteria into your investment strategy, along with their respective pros and cons to help you decide what's right for you. The first one is exclusionary screening. This is the oldest method, and it's sometimes the first approach that people associate with socially responsible investing because traditional social responsible investing is driven by avoiding investments with objectionable activities. So exclusionary screening removes companies from your portfolio based on the products or business activities that conflict with your values. So that might include businesses associated with alcohol, tobacco, gambling, oil drilling, or weapons manufacturing, just to name a few examples. The pros of doing exclusionary screening is that the negative screening is a values-driven approach that lets you align your investments with an investor's ethics, morals, or religious beliefs. For example, if your religion prevents you from investing in certain companies because of the products or the services they sell, exclusionary screening can help you eliminate those businesses from the portfolio. And this approach allows you to participate in markets on your own terms, which is certainly better than keeping 100% of your money in cash. On the con side, research suggests that this approach is kind of harmful to your overall returns, and it may leave you less diversified than you otherwise could be using a different investment strategy. But worst of all, negative screening could end up excluding companies you actually like overall. For example, a strict exclusion for alcohol could require you to reject a company like Amazon because it sells alcohol through its grocery store chain, Whole Foods. Another example that happened years ago when I had to build and manage a portfolio of individual stocks based on a rather strict set of exclusions, the client was surprised that we couldn't include AT&T, but you could access the Playboy channel through their cable business, which caused AT&T to turn up on the exclusion screen. So I always think it's those issues that drove me to dislike ESG investing, sort of in the way that I referenced at the beginning of the episode. These negative experiences through these exclusionary screens really shaped my feelings. But these days, there are a lot of funds out there that use an alternative approach to the exclusionary traditional approach, and instead use the ESG factors, such as the potential impact of climate change, or labor standards, or board composition, to analyze investment risks and opportunities. This is commonly called sustainable investing or responsible investing. And again, I'm using these to set a framework and some definitions because so many people use these different terms interchangeably. But generally speaking, I see sustainable investing or responsible investing referring to something that's utilizing a positive screening approach to promote desirable outcomes while also pursuing financial returns. So unlike the traditional exclusionary approach for socially responsible investing, positive screening rewards companies with good ESG qualities with the goal of boosting long-term risk-adjusted returns. For example, instead of ruling out Walmart or Target because they sell cigarettes, just as an example, These companies might be included in such a portfolio because they're among the top 4 users of solar panels in the United States. The primary way that you're going to see positive screening utilized in funds these days is through what's called a best-in-class selection. And it's an evolution from this original exclusionary model. Rather than excluding the companies, they score all companies in a representative index on a host of ESG factors. Then it rewards the leaders on ESG metrics by overweighting those stocks within the index. And just to give you an idea of some of the different ESG issues that can be scored and screened on, for environmental issues, things such as air emissions and air quality, fossil fuels, hazardous material use, land contamination, water use and conservation, waste generation. I've only read just a handful of those on a list that comes out from Vanguard. I'll be sure to link to that in the show notes, or at least share the image there. On the social side, a few of them that I'll just read randomly: adequate housing, adult entertainment, alcohol, income inequality, tobacco, consumer privacy, obesity, weapons, workforce exploitation. On the governance side, we have antitrust violations, consumer fraud, political contributions, reporting transparency, voting rights, oversight of strategy, executive compensation, board diversity. Again, just reading a couple of the many that are listed here. The pros of an approach like this is that the positive screening, again, lets you align your investments with your values or your sustainability goals by underweighting or avoiding the companies that don't excel in ESG. But just as important, the research shows that positive screening doesn't necessarily hurt performance or harm diversification. On the con side, I think the primary drawback to positive screening is limited information. ESG data isn't standardized yet, and it relies on companies to self-report. So the ESG data sets used for security selection aren't perfect. On to the next approach, which can sometimes be classified as positive screening, is ESG integration. The ESG integration approach examines ESG criteria alongside traditional financial analysis. In this method, it recognizes that issues like climate change, social inequality, and corporate governance can affect a company's long-term performance. But ESG integration strategies don't emphasize specific ESG-related goals. Instead, the point of the integration is to use ESG factors to pursue better risk-adjusted returns. So the pros of this approach is that when you examine ESG factors, it gives you more information to help assess a company's risk profile and return potential. And research suggests this may help improve risk-adjusted returns over long periods. On the con side, again, the data used to analyze stocks is limited and non-standardized. Plus, true integration approaches are usually only available in active portfolios, which unfortunately tend to underperform simple indexes in aggregate. So of the two positive screening approaches, the most product development being done these days is in the best-in-class methodology, in part because it's relatively easy to manage once the rules for weighting ESG scores are created, and the end product is relatively easy to understand. So far, I've highlighted 3 approaches to ESG investing: exclusionary screening, best-in-class, and integration. And while the most popular ESG funds invest in securities based on overall ESG performance, there's also more targeted ESG strategies, such as thematic funds. Thematic funds focus on a single ESG-related area, such as clean energy, sustainable forestry, female leadership, or good board governance, just to name a few. These funds then seek to invest in companies that are most actively working to address the chosen issue while avoiding those that are not. So the pros of a thematic investing approach is if you're passionate about one particular issue, this method allows you to allocate your dollars to companies or to projects that are directly related to what you care about most. On the con side, because these funds are built around narrowly defined themes, they can lack diversification. They can also put the non-financial objectives over the financial ones, which can sometimes result in higher costs and may hurt long-term performance. A fifth strategy is impact investing, and impact investing is even more targeted. And as the name implies, it tends to explicitly prioritize impact over return, which is pretty unique among ESG strategies. So this is a highly targeted approach that invests in particular projects designed to achieve specific measurable goals, such as building affordable housing. The focus here is less on generating a financial return, and more on using capital to create positive change in the world by meeting specific social or environmental outcomes, whether that's constructing low-income housing, water sanitation, or clean energy initiatives. These are just some of the things that impact investing would expect. The pros of this approach is that because impact investing has clearly defined goals, you can put your money to work directly towards solutions for issues or problems that you feel are most important for the greater good. The financial return potential is a clear step above charitable giving because you expect to generate some type of return on your investment, so you're not just giving your money away. On the con side, this method does tend to produce below market rate returns. There's often a lot of risk involved too because you're dealing with highly concentrated projects. One more final strategy for ESG investing that I always like to call out and remind people of is active ownership or corporate engagement. So active owners use their ownership rights to directly engage with companies on ESG issues, such as using proxy votes to try to change the behavior or practices of the company. I tell people all the time that all it takes is owning a single share of a company to show up at a shareholder meeting and raise hell, file complaints with regulatory authorities, and send letters airing your demands. The pros to this approach is when you take an active role, you can make your voice heard. This corporate engagement gives you a chance for a more hands-on role in pushing for change. The cons is that having true influence through active ownership requires you to own a major stake, which is why some investors will pool their resources and do this as a group. But most individuals really just don't have the time or bandwidth to be active to the degree that would be required to influence significant change within the corporation structures or their means of doing business. And even if you do show up to meetings, there's no guarantee you'll see results. So those are the 6 approaches. And because there are so many approaches to ESG investing that you can choose from, each with very different objectives, understanding the different ESG implementation methods, I think, is critical. But if you want to be an ESG investor, you also need to know what your motivations are. If your motive is to strictly align your investments with your beliefs and values, even at the cost of investment performance, then you'll probably want to use an exclusionary screening to keep the companies out of your portfolio, or choose targeted thematic or impact investments that align with your beliefs. But keep in mind that doing so might limit your diversification options for your portfolio, and the research suggests that it could hurt your long-term returns. If your motive, on the other hand, is to do some good with your money while preserving investment performance, or if your motives are purely financial, then using a positive screening or integrative approach to ESG investing may appeal to you instead. Research also suggests this approach has the greatest potential for improving risk-adjusted returns, but also is less likely to be harmful to returns than that exclusionary approach. For investors that are taking a positive screening approach, critics often complain that ESG data is limited and that it's non-standardized and it's biased because companies are self-reporting. And this is all true to some extent. But I do think that that bit of criticism misses the key point, that these companies who are reporting, they're willingly turning over more information. And that provides us as investors additional criteria that we can use to evaluate them. In fact, one academic study found that companies providing greater transparency into their operations outperformed others in down markets. Another paper found that the companies with the lowest ESG scores are more volatile, and I can link to both of those papers in the show notes. But while it's easy to get hung up on the nuances of the data, my take is that more information is always better for investors trying to assess a company's potential. So, if you're considering ESG investing, take the time to understand your motivations and go in fully aware of what each approach is or isn't trying to accomplish. That way, you'll be more likely to find a strategy that does some good for the world without doing harm to your own financial goals. There's no right or wrong reason to be an ESG investor. From my perspective, though, a positive screening or an integration approach to ESG investing makes the most sense. But either way, ESG potentially offers one more important benefit. It can help you manage your own behavior. In my experience, the ability to weather market volatility and stick with an investing plan is critical to achieving positive returns over time. And if doing well with your money, if aligning your portfolio with ESG goals provides some sort of emotional attachment to your portfolio that's going to make it more likely for you to stick with an investment for the long haul, then that's a good thing in my book. Now, there's one final thing on ESG investing that I feel obliged to discuss. As interest grows in ESG investing, a lot of people may wonder why their 401k plan doesn't offer ESG funds. I've even noticed some smart financial thinkers suggest that people should lobby their employers to add ESG funds to the 401k lineups. And at first glance, the logics may be there. For many investors, the savings in their 401k accounts may be the bulk of their wealth, and they want to invest in a way that reflects their values, and so this is the way they could do that. Plus, I just said earlier that there's a growing body of research that shows that companies doing a good job of addressing ESG issues in their business tend to outperform companies that are doing a poor job on ESG. Yet for all the good reasons to pursue an ESG investment strategy, I just don't think 401ks are the place for ESG funds. Let me explain. A workplace retirement plan is designed for a diverse group of participants, which creates variables that don't exist when you're constructing a portfolio for an individual or a family or an institution. Employer-sponsored retirement plans, like a 401k, use only one set of investment options for a wide range of investors with varying degrees of sophistication, wealth, and circumstances. And the trustees of these plans should manage them in a way that upholds the employer's fiduciary duty while meeting their primary plan design objective, which is to select investments that encourage investor participation while minimizing potential mistakes. Now, I don't believe the use of ESG funds necessarily represents a failure to uphold a fiduciary duty, but I am concerned about the slippery slope that it creates around participant behavior, which should very much be a part of the trustees' concerns. There's a couple papers that I can link to, and there's also an article that I wrote for the Wall Street Journal that I can reference that talks about a couple different academic papers. The first is one in 2001 that just challenges the assumption that more choice is better for investors in a 401k plan, as it can lead employees to do nothing rather than make a selection from an overwhelming amount of options. In 2004, there's another paper that I reference. There's another paper in 2004 that studies nearly 800,000 employees, and it finds that participation in 401k plans is higher for plans offering a handful of funds compared to plans offering 10 or more options. So while it might seem that adding ESG funds might encourage additional employees to participate in the retirement plan, the research, in my opinion, suggests the opposite. The more fund options that are added to the 401k, the higher the chances that some investors simply don't participate. Without eliminating other fund options, adding ESG funds to a menu of choices is only likely to drive participation down. But let's say that you add ESG funds, and let's even say that maybe you subtract some funds out of the plan as a result of it. In this case, for participants who do engage and make investment selections, plan trustees have to worry about the harmful mistakes investors might make. And in my direct experience working with plan participants, the most common mistakes I see include performance chasing and false diversification. Performance chasing is interesting because despite the common warning that, quote, past performance is no guarantee of future results, many 401k investors regularly change their investment mix, dumping the lagging funds to invest with those with the best recent performance. This behavior, the problem with it is it locks in the relative or the absolute underperformance and leaves investors expecting big gains that may not materialize. This seems particularly relevant today, given that many ESG funds have recently outperformed simple index funds during the last 1, 3, and 5-year periods, which are the periods of performance often displayed alongside the fund options in employer-sponsored retirement plans. So by adding ESG fund options, trustees may be inadvertently increasing the temptation for employees to chase performance and end up with smaller returns over time. The other thing I mentioned is false diversification. When there's more funds to choose from, an employee might decide to invest in nearly all of them, thinking that the more funds provide more diversification for their portfolio, when in reality, the participant's selection frequently results in owning multiple funds that invest in essentially the same way. So adding an ESG fund to your plan may not actually help you diversify an investor's overall portfolio at all, particularly if participants lack a basic understanding of asset allocation, which in my experience, most do. So the decision to add ESG funds to a 401k plan, I think ought to go beyond considering the merits of ESG investing in a vacuum. In my opinion, if you're a plan trustee, you have to consider the behavioral implications in designing the fund lineups to give your employees the greatest chance for success. And there's plenty of evidence that shows that adding more fund choices to a plan increases the likelihood of investing blunders. But if you have people who want to add ESG, or you're one of those people who want ESG in your portfolio, some other things that you can think about doing is using the money outside of your retirement plan to advance ESG issues, or taking that active ownership approach I mentioned earlier, where you buy a single share in a company that you really dislike from an ESG perspective and go to their shareholder meetings and add your name to proxy votes among groups who will vote your shares as a collective to make impacts that you want to. And then there's a final way that I think is often overlooked, which is just to give your time and talent. It's overlooked, but it's a really powerful one. You might start by identifying policies in place with your own employer that you'd like to see changed, and then addressing those with the company's management. Maybe that means leading a team that makes recommendations on establishing a more equitable parental leave policy, or reducing the company's carbon footprint, or increasing diversity in the workplace. Or if there's a community organization you'd like to support, but your financial resources are limited, think about other ways you could contribute, such as volunteering on weekends or taking an active role on the board. That's all I have for now on ESG investing. I want to thank all the listeners and my readers for sending me so many great questions following the Q&A that I did in the prior episode. Keep sending me questions. I'll be sure to do another mailbag episode once I've collected a few that I think go together nicely. And as a reminder, you can always find show notes and free resources, as well as a place to submit questions by visiting thelongterminvestor.com. If you're enjoying the show, please consider leaving an honest review. That helps other people find the show. And I'm reading all of those, and I appreciate the suggestions. I want to hear from you directly. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.